So today we're going to be going over my dividend investing portfolio. I sold some dividend stocks recently as well as moved over one of my Vanguard ETFs. So I switched that over. We're going to break this down and take a look exactly why I did some of these things. So we're going to be on my M1 Finance investing portfolio, nicely named Dividend Dennis. I do also have some growth portfolios that we'll kind of go into in later episodes. Now, if you are somebody who's interested in getting started with an investing portfolio and want to use M1 Finance, they still have a current promotion where you get a $30 bonus when you use my link in the show notes down below. Nice thing is, supports the channel, but it also gives you a nice little starting bonus for your account. Now, what we're going to do is actually take a look here, kind of see how this portfolio is doing just kind of over the last couple days. So we are sitting at our newest high right now, which is 22,487. Right now, obviously for the day, it didn't do so well. We're down about $93 in total. If we go to the week, we're actually still up on the week for about $121. And then if we go to the month, we're still sitting at a nice $433. And then if we go to the quarter, we're almost at $2,500 for the quarter. So which is really cool, because if we look back in November, which was last quarter, we were sitting at almost $1,600. So a huge gain as far as what we're putting in, because it's slowly building up more every single week, as well as these nice gains. And then we can see for the last year, almost $4,400 in total. About 240 of that was earned dividends. Some of it still yet to be paid out, though, so keep that in mind. And then for any of those people that are watching that are like, that's a lot, I can't do that myself. Hey, look, I started off with $100 in my portfolio, and then I slowly was trying to understand where I wanted this account to go, and then I started investing slowly over time. So if you look in the first year, I think I gained maybe, I was like around, $1,300 is what I got in the first year. So by the second year, if we go to January 23rd, 2021, give or take around there, it's around 21,000. So a lot of that had to do with feeling more comfortable, investing more, obviously getting those gains as well, and then earning those dividends on top of that as well too. So let's kind of break this down a little bit. If we're in our all tab, actually before I do that, for some people who want to know as far as unrealized gains, this is going to be a little off because I just sold some stocks and transferred some things over. But my unrealized gains is $3,600, which is about 20%. But again, it's a little misleading because I just sold some stocks, so some of that profit is now gone from unrealized, which is actually why I like the money weighted returns right over here. I don't care for the percentages, to be honest. I think this stuff seems a little wacky. I just like the fact that my gains that I had from those profits that I sold are still calculated in here, so I know long term how much I've actually made from here. And if I sold stocks for losses, those will take that total gains down in that total overall. But you can see here, obviously I got a growth stock, so I'm not all focus on dividends here. I do also have growth, and that one is obviously one of my best ones here with almost $1,300 in positive gains. My tech pie here has about 900. My finances almost 900. We got industries and energy around 163. Those are some newer stocks in there, so it's kind of skewed off a little bit there. My retail is about $400. This one right here, the S&P 500 ETF, is my newest one that I just switched over to, which we'll talk about. That one we're actually technically down, but long term we've actually just transitioned from one to the other. And a couple of the other pies here are doing pretty well. So let's go ahead and kind of break down what we did here most recently on this account, just to kind of go over some stuff. So we see here on February 10th, we did a trade. So we did 6 buys and 3 sells. So if we go into this, let me close that out. So you're going to see here, so we actually sold out of 3 different funds right over here. So we sold out of Vanguard. So I'm going to kind of explain why I sold out of Vanguard, because I do love talking about them, and I've always mentioned that it's great to go with Vanguard. But there's a good reason for this, and actually somebody in the comments in the channel here actually mentioned something, so I did some more research and ended up finding out that I could get a better deal long-term being in a different fund, which you can see it's this one right over here. It's the SPYG. Effectively, it's the same fund, and I'll again break down why that I did that switch. Then we sold out of Pfizer right over here entirely. So this is completely getting out of my position with Pfizer. as well as completely getting out of my position with Hasbro. And because of the way that M1 Finance works with the sectors, so my Hasbro funds went into my P&G and into my Pepsi, and then my Pfizer went into Johnson & Johnson and AbbVie. So those funds were just kind of like evenly distributed between the remaining stocks that were in that pie, and I was totally fine with that. I had no problem. And then my Vanguard fund here mostly went into the similar fund, which is the S&P 500 growth, but a little bit of it also went into a somewhat new fund, which is the Texas Instrument, ticker number TXN. Although I've actually had Texas Instrument on my portfolio before, I'm just kind of reintroducing it back in. So a little bit of that VOO fund went into Texan or Texas Instrument, and then I added a little bit of a deposit to have that money go in too. So why did I do this? Why did I go through this whole process? So let's kind of talk about Vanguard first and foremost, because this will be the easiest one. So if we switch over to Seeking Alpha, let me make sure my screens are nice here. So if we go into VOOG here, so this one is the Vanguard Growth Fund. So this is effectively around the top 250 funds in the S&P 500. They tend to have better performance than just the regular S&P 500. But this is the biggest thing about that. So if we look right over here, like in the last year performance, about 30.32%. If we look in the year, or the 5 years, it's about 159.46% growth. So really good growth. And the expense ratio right over here, you can see, is 0.10. So if you are somebody who maybe has the Vanguard S&P 500, just regular fund, not the growth version, the expense ratio is 0.04, I believe, or 0.03, one of those two. But because I focus more on the growth side of things with this fund, the expense ratio is much higher on the VOOG version of this fund. So then when I was like looking around and I talked about it here on the channel, I had somebody mention to me to check out SPYG, which effectively is almost the exact same fund. If you actually look at the last year, they have the exact same growth just in the last year, which is 30.32. And then in the 5 years, it's 158.18, which is, I think, just slightly different from the Vanguard fund. But take a look at this. Look at the expense ratio. The expense ratio is 0.04. Now, that might not seem like a big deal for most people, mainly because you don't even see that expense coming out of your own pocket. But that is a huge percentage when it comes to differences between 0.04 and 0.10 when it comes to expenses. So for me, I was like, okay, if I switch over now long term, as my portfolio gets bigger, as my funds get bigger, that difference of 0.06 is going to have a massive amount of savings for me as this fund continues to get bigger. So that was actually the main reason for switching for these two. Like I said, somebody actually, I can't even do arrows. So that's why somebody mentioned it here on the channel. I actually checked it out, did a research for about like 2-3 weeks, just double checking stuff and just kind of making that decision of, do I want to switch over from Vanguard, especially because, Vanguard's a bigger name, but effectively these funds do the exact same thing. So I went ahead and did that swap over for it. So obviously when I did, that takes away the, let me get that line out of there. That takes away the unrealized gains from that. And then when we go back to the portfolio, we can see here, after I bought it, it went down 0.53%, which is about $11. So nothing too crazy there, but long term, I still think that this fund is going to do similar to what the Vanguard fund did, but just going to save me some extra money. Not that this makes a big difference, but the price point is a little bit lower, which means now it looks like I have more shares, but effectively is the same thing, right? I took that same money, $2,100 or so, and just moved it over. So this effectively doesn't change anything because they're similar in what they have invested in. Very similar dividend yields as well too. But again, the biggest difference was the expense ratio, this thing right over here. That's the part that I actually cared about the most because I want to save more money long term in that aspect. So the next thing I want to look at too is getting out of Pfizer and Hasbro. So if I go on to seekingalpha.com, I have a section here with my portfolio. Let me close that off. go away. Perfect. So here I can see all of my stocks that I currently have, and then we're gonna go to Pfizer here. So Pfizer had a nice pop back in like December or so. Kind of wish I sold at that point because I was really debating on it, but I just didn't. So I'm kind of selling on a downward trajectory, which I don't normally like to do. I still made a profit from the sale between its actual gains and the dividends that I earned from them. But because this is a dividend mostly focused portfolio, I do also again focus on some growth. I was taking a look at the dividend. Obviously, it has a very nice yield right over here. So it's a 4.46% percent yield. The payout ratio is really nice and low, but they're just not seeing a lot of opportunity for long-term growth with the dividend in comparison to the other two funds I have in my health. So if I go back to here. I like dividends. I really do care about dividends, and I want dividend growth, and I also do want appreciation too. So I have Johnson & Johnson and AbbVie as well, which I think are going to be able to provide me a little bit more stability in the dividends. So if we look here, Pfizer recently, back in December, announced a dividend increase, but it was only for 2.6%, which is fairly low. It's barely keeping up with inflation. And then, So if we actually look at that, it really kind of, makes me not very excited for the longevity of Pfizer. And then the biggest thing that I think that really caught my attention was when I went to yield on cost here for Pfizer. This kind of just gives you an idea of like where everything is going to be long term. And if I jump to 20 years, so if you look at the 20-year projection from where, not projection actually, this is real data. This is where we are today here on the left, and then on the right was 20 years ago. So this chart works backwards. So if we look here at its peak, what was that? 2009. The share price was about $12.31 plus with the dividend increases and everything that happened. You can get a max of 12.67% yield on cost, which is you're essentially getting 12% dividend yield, which is fantastic. But like, do you see like this downward trend right over here? That's because, let me actually open up a new tab here. When we look at Pfizer over the years, it's had a nice spike and it's gone down, and now it has this nice little spike. And I just don't know if I see longevity in the same way that I do with Johnson & Johnson or with AbbVie. Obviously, this is just me kind of looking at some data points and trying to see like, is this going to be worth it long term for me with the dividends and everything else that's coming out for it. It could still be a great company. I just feel like it'd be better off just more so focusing on two health companies, right over here. So that way more of that money can be poured into these companies and then have that growth for the dividends, have more shares for each of these companies, which obviously is going to cut down the amount of times I get paid out from dividends, because now instead of, three health companies, I only got two. But if I look, I just don't see the opportunity the same way as I do with like Johnson & Johnson, as they have a healthier dividend growth over the last couple of years. And the same thing with AbbVie, with the growth as well as their opportunity for, the actual value of the stock going up as well too. So that's one reason I took out Pfizer from the portfolio. And then if we go back here under my activities, so the other thing that I took out was Hasbro. And this one was a little bit of an easier decision than it was for Pfizer. Again, I was just wanting to clean up the portfolio a little bit more. So let's go to the scorecard here. So Hasbro has been coming back up in price over the last couple of months. I actually bought them at a very low price point, and I have a lot of gains from them. So that was a nice thing, honestly. I wasn't really expecting it to grow that fast over the last couple of months. Obviously, nothing like some of the other stocks over the last couple of months where they, got back to their pre-February 2020 price points. So this one is taking a lot longer. But if we go to their dividends here, their current yield is 3%, so it's not bad. But here's the problem. So they just lost their dividend growth right here. So they haven't increased their dividends for quite some time. Actually, if I go to their dividend history here, let's go and take a look. So right now they just recently announced their dividend payout, which is 68 cents. But if you scroll down enough, we can see here that the last time that they increased the dividend was in February of 2019. So it's been now 2 years since they've done a dividend increase, and that doesn't bode well for a lot of dividend investors that are wanting to have companies that are constantly increasing their dividends to hopefully increase the yield on cost that you have, so that way you are making more money every single year. Because at this point, with the way inflation goes and, money becoming less valuable over time if it's not growing, you're effectively going down in your earnings for this dividend, because, 68 cents a share back in February of 2019 has more buying power than 68 cents in February of 2021. So without those dividend increases not even keeping up with inflation, it's hard to tell, hey, is this going to keep going on? Is there going to be good opportunity down the road for dividend growth? Even a small increase is better than no increase, but to have that for 2 years, that's a good reason why, for me, I decided to take that money out of Hasbro and, like I mentioned earlier, put it into Pfizer and put it into Pepsi, where those two companies have better longevity when it comes to dividend increases, so that way my money can keep staying at its value and or going up even higher beyond that. So those are the main reasons I ended up getting rid of Pfizer and Hasbro. Everyone's going to be different. These are just my decisions. Sometimes it's actually hard to sell your stocks, especially if you've had them for a long time, like I have some of these. So, it's not always the easiest decision on that. Like I mentioned, I did end up adding a stock, which was Texas Instrument. So now if I go to my holdings, I'm now down to 27. I was 28 or 29 stocks total at one point, so I was definitely holding on to a lot. I like the idea of condensing down how many shares I have, just because that way more money goes into the stocks that I think are going to do well for us long term to be able to hit our goals. One of the big goals I have is in 15 years to hit about $10,000 a month in dividends, give or take. It's going to be a hard feat to make, but I feel like if I just keep talking about it, maybe I'm just going to keep pushing myself to really pay attention to everything, make sure that my stocks are doing well, and continuing to grow long term. So you can see here, again, we have the 27 stocks in total. So we're going to be doing pretty well there. And I'm pretty happy with the ones I have now. So we'll make sure that we stick with those ones. And if I do continue to change them, I will share them with you guys, because I like making sure that my portfolio is doing well, and I haven't done a lot of selling. Let me see, actually, if I go here, does it show me? So deposits, withdrawals, trading. I wonder if I can see the selling as well too. So I sold there, and let me see if I can find this really quick, because it's been a long time since I sold any single stocks from this portfolio. But November 18th, what did I sell? Oh, that wasn't even me. That was one of the companies I had a split, and so they did a forced sell on me, which was fine. I didn't really mind that. Kraft Heinz was the last one I sold, and that was back in October 23rd of 2020. So it's definitely been a long time since I've actually sold a stock from my portfolio and my holdings, just because I don't want to do a lot of that. And obviously, create taxable events, because that happens. Selling for a profit, I gotta make sure I keep that in mind. But I also I want to be very consistent with what I'm having. I want to have a decent amount of shares. If you can see here, obviously Apple's a great stock to have in many portfolios. I only have 17.85 shares, which obviously I know is more than others, but at the same time I want to make sure that I'm really focusing in on the ones that I think are going to do very, very well long term. And then I have only 8.5 shares of Microsoft. I got 2 shares of Tesla though. That's awesome. Next Era Energy, I got about 11 shares. Home Depot, I only got 3. Sometimes that might not seem like a lot. Obviously, the share prices do have an effect on how much I can have in shares for that company because of the price points. So higher price points makes it difficult. I don't even have a full share of Amazon yet. I got 0.245 shares. So getting close. About fourth of the way through of having a full share of Amazon. And just kind of those different situations when it comes to building up that portfolio. The other thing I'm really debating, and I brought this up before, and if you guys want, you can let me know in the comments what you think, and be honest with me too. So I have AT&T, and when I was doing all this change up on my portfolio the other night, I was really contemplating about finally getting rid of AT&T. So let me kind of just go over that. I'm reading all these different articles, and let me bring it on to Seeking Alpha here so we can see it. Maybe I can find that article I was reading. I read these articles back and forth, and I mean, maybe this is why some people watch like YouTube videos, is like trying to decide like what they want to do too. So currently with AT&T, I have about almost $800 in there. Right now in my all-time, I'm technically positive 79 cents. The actual market gains are down. So I'm actually down on the portfolio as far as unrealized gains, but because I have earned dividends, I'm actually positive. So I could break even right now with AT&T, and then I can funnel that money into more more Apple and Microsoft stock. And then that way I could focus in on the appreciation with those companies as well as the dividend increases that those companies have. But the big thing with AT&T is that they have a dividend yield. Ooh, that was ugly. They have a dividend yield of 7% right now. So I think, what did I do? Let me see right now. Let me see what my actual yield on cost is, which, by the way, if you don't know how to find out your own yield on cost, this is a great way to learn. So you take the annual dividend payout, which is $2.08, and then you divide that by your average share price. So divided by 29.96. And then you could times it by 100 if you want to make that easier. So my dividend yield is 6.942%. Obviously, the dividend, actually, let me see what the actual dividend yield is. 7.27. So my yield on cost is actually lower than the current yield, which means if I buy now, my yield is actually going up. But I've been reading a lot of people talking about how AT&T is kind of becoming a yield trap, which is essentially having a really appealing looking dividend yield because 7% is a nice return on your money, or a decent, I should say, return on your money, not really nice, but decent. But the problem is the value of the company, the share prices are going nowhere fast. So like, look, in the last year, so you can see here when everything, kind of kerplunked, it's down still 25%. I mean, look at most companies after everything has happened from early 2020. They've recovered and then quite a bit some, right? So down 25%. Luckily, I didn't buy in this top piece here because you saw my average price was $29.96. So I didn't buy it the highest. I think I did have some prior, and then when it dipped really, really low, I was like buying a lot, and especially around this time here, it was like around $26. I was buying more in, so it helped me dollar cost average by buying at a cheaper price point. But it's not doing anything. Like, look at this line. It's like relatively flat, right? And then if we even go further back, because I'm like, well, that's just the year. Maybe they're just having a tough time. Like 5 years and then 10 years, like. Look at this. This thing is just like up and down, but like not in a good way. Like it's not moving consistently up like a lot of other stocks do. And to think if I held on to this stock for 10 years, like all the way back here, I'm only up 2.32%. Now, also to keep in mind that I would have been earning dividends every single month, or not every month, every single quarter, and like that obviously would play a part, right? Because then you can calculate those in, just like you saw here on my thing, where even though I'm down on my actual market gains, my earned dividends break that even for me. How would those dividends earn over a period of 10 years? Because if you're buying it at this point and then you're earning all these dividends, that might make you more than break even. But when you consider the fact that, let me close this off. If we go to Apple, obviously again, very popular stock and everything, right? So look, 70% in the last year, that's fantastic. Let's go to 10 years, 963%. And I'm not just trying to like sway away myself from the idea of like dividends, but like look at that market value, just like it's just like a straight shot up. And like their dividend yield is obviously not good, so people don't buy them for the dividend, but let me look at the yield on cost, because this is a big deal too. I love looking at yield on cost. So in 10 years, so right now the dividend yield is 0.6%. If you bought them 10 years ago, this is the part that like blows my mind, and I don't think a lot of people talk about this, is that so because of the splits and everything, 10 years ago, their dividend would have been $12.66 a share, which is just like mind blowing to think that in 2011 you could have bought Apple shares at that price point. Look at that yield on cost. Would have been 6.48% based off of you buying the shares at that given price. Now, obviously, back in 2011, 10 years ago, the yield was not 6%. The yield was actually, I don't even know, did they have a yield back in 2011? Because they more recently like started opening up the dividends and stuff. I'll have to look, but realistically, if you think about like even if they weren't selling or weren't giving out dividends at that point, based off of the price point of the shares and what the dividend is now, you would still effectively be getting a 6% or 6.5% on your money, which is mind blowing in my eyes that a company is having that great of value increase on their share price as well as paying you out that percentage of dividend. Like that is so crazy to me. Like that is so cool because that just means that the dividend increase that they give out is so powerful. And I'll show you here too. So like let's go into the dividend news. So look, I mean, this 6.5% is not crazy, but for 2020, right after everything crazy happened, they increased their dividend by 6.5%. So they went from 77 cents to 82 cents. And then the year before it was 5.5%. But again, like I think there was a couple times 2018, they increased it by 16%. That's nuts. The year before that in 2017, they increased it by 10%. So, I mean, if they can keep, relatively close numbers like that, theoretically speaking, in 10, 15 years, 10 years or so, that could be the case for me too. I could be getting 6.5% on my money. So let's take a look here. Let's find out my current yield on cost right now. So they pay out 82 cents a year because they did the dividend split, so it doesn't seem like much, but their price points is a lot lower. So let's see what my average cost was. Oops, I went too far back. So go to Apple. All right, so we can see here. So my average share price, so divide that by 106.66, and then we're going to times that by 100. So my yield on cost is 0.76%, and the current dividend yield is 0.6%. So what that means is that with the amount of stocks that I have bought at the price point that I have bought them in, with the yield increases that they've done over time, that my payout on dividends is better than somebody who's buying in today, which is really, really cool. Obviously, I'm still going to be buying into Apple, so my yield will probably go down a little bit because I'm buying at a higher price point. But I am getting a better dividend payout on my money that I invested with Apple than somebody who's, again, investing in today, because my yield is higher since I bought it at a cheaper price point and they've increased their dividends since that given time. So that's just going to amplify over time and continue to increase. Oh yeah, look, 9 years is when they've been paying out dividends. So let's go to dividend history. Oh yeah, see look, they didn't even pay back in 2011 dividends. So yeah, the thing we were talking about, like that is only applicable once they actually started paying out dividends. But if you were a shareholder before they started paying out dividends, you still got paid out those new dividends once that started, which I think is so fantastic. Which is really cool too, because at that point, I don't know when or if any of these growth companies are going to pay out dividends in the future, but like if Facebook, Google, Amazon, or even Tesla in the future at some point pays out dividends, and I own shares of these companies, like those dividends are just going to start rolling in, and hopefully by that point, if the share prices are much higher, and what I'm getting paid out in dividends is probably going to be a really good value for me and a good yield on my cost based off of buying them now versus buying them once they announce those dividend increases. Now, I think one really big thing when it comes to getting with investing is to constantly keep learning throughout the process. So check out my video right over here to watch more videos when it comes to me utilizing my portfolio and going through and talking all about it. My name is Dennis, and I will see you in that next video.